Good morning, everyone. Darius Dale here to present our macro minute for Monday, March 7th, 2022. Starting with markets, we have stocks down this morning, commodities up, crypto down, dollar up, global bond yields up. Big movers, we have Germany's DAX, Japan's Nikkei 25 index, the MSCI emerging market index, and Ethereum all down nearly 3%. WTI up nearly 7%, and that's dragging the euro 5-year forward inflation swap rate up 18 basis points as the market attempts to price in the potential removal of Russian energy supply to the broader continent. On the macro front, Friday's February jobs report contained incremental evidence of three key themes that we believe will heighten the risk of a wily coyote moment for risk assets with respect to Fed policy later this year. So, number one, robust demand for workers. Number two, still depressed labor supply. And number three, a worsening supply demand imbalance that is putting upward pressure on wages. So, with respect to number one, robust demand for workers, we saw headline payrolls accelerate to 678K month over month to 150.4 million total payrolls. That's the fastest pace of gains we've seen since July. Average weekly hours accelerated 110 basis points to 5.2% year over year. That's the highest print we've seen since August of 2021. And then the employment diffusion index, which is a measure of breadth, that accelerated 1,550 basis points to 76.6% of industries seeing month over month gains. That's the highest level we've seen since March of 2021, and that's the fastest acceleration we've seen since May of 2020, coming off the lockdown lows. With respect to number two, still depressed labor supply. We saw the labor force participation rate tick up only 10 basis points to 62.3%. That's the highest we've seen since March of 2020. We saw the 55-year-old plus labor force participation rate was unchanged at 39.1%. So still some evidence of hysteresis developing there with respect to the quote unquote great retirement or great the great retirement. And then lastly, female labor force participation rate. This is one of those big things that a lot of economists are hanging their hats on in terms of improving labor supply, but it's actually going in the wrong direction. Tick down minus 20 basis points to 56.6%. That's the lowest print we've seen since December. And then lastly, with respect to number three, we have a worsening supply demand imbalance that is putting upward pressure on wages. So one thing we've been tracking is the total number of jolts divided by total unemployed workers. So we're using the December jolts data. That data comes out in the lag relative to February's total unemployed workers. That ticked up 0.4 points to an all-time high of 1.74. Average weekly earnings accelerated 120 basis points to 6.6% year over year. That's the highest print we've seen since March of 2021, and the fastest acceleration we've seen since June of 2021. And then lastly, on a seasonally adjusted annualized basis, taking it to the chart here, which I think is the more relevant statistic to track, we actually saw average weekly earnings accelerate to 7.35% on a month-on-month annualized rate of change basis. So we continue to build in, wage pressure, wage momentum relative to the year over year, which suggests we're likely to continue to see the year over year time series continue to accelerate. And that's obviously something that puts the Fed in a bind with respect to the commodity price inflation that we're seeing. That's really, to me, and it's not a sideshow as it relates to the economy, but it's a sideshow as it relates to policy. What the Fed is really focused on is the development of sticky inflation, of median CPI, of wage inflation. Those are all the things that force it to acknowledge and defend its price stability mandate, as Fed Chair Powell confirmed last week in a Senate testimony. Shifting gears to our probable range setups, overbought signal in WTI, the Euro 5-year forward inflation swap, copper, silver, and gold. Oversold signals in Germany's DAX, MSCI emerging market index, the Euro 1 year 1 month forward overnight index swap spreads, overnight index swap forwards rather, 10-year Boon, 10-year JGB, 10-year Swiss yield, 10-year gilt yield, 10-year treasury, and 10-year tips. So a lot of global nominal rates and real rates are oversold this morning with respect to those probable ranges. S&P 500 is bearish VAMs minus 6.4% of downside versus 4.1% of upside. WTI still neutral VAMs. OVX is still obviously in the wrong bucket for this thing to be a raging bull, but obviously it is a raging bull in price terms. Minus 31% of downside, and it's at the upper boundary of its probable range. Bloomberg Dollar Index still bullish VAMs minus 2.1% of downside versus 0.2% of upside. 10-year Treasury yield is at the lower boundary of its probable range with 44 basis points of upside. Bitcoin still bearish VAMs minus 17% of downside versus 10% of upside. Ethereum's bearish VAMs still minus 17% of downside versus 14% of upside. And then gold minus still neutral VAMs. Gold 10-year tips yield, which is the volatility adjustment factor we use in that model, still not broken down sufficiently enough to put gold in a official bullish VAM state, but that's something we're obviously watching. So still neutral VAMs, -7% of downside, and it's at the upper boundary of its probable range this morning. So with that, Darius Dale presenting our macro minute for Monday, March 7, 2022. Best of luck out there this week. Cheers.